In 2022, you did not just watch a market crash, you watched $2 trillion disappear, and most of it did not have to. This video is not a list of generic warnings. What you are about to see is a forensic reconstruction of 10 specific, documented mistakes, each one traced through a real exchange collapse, a real corporate failure, a real moment when someone's savings evaporated, and then mirrored directly to your portfolio. By the end, you will understand not just what went wrong, but exactly when the decision was made that made it inevitable. Mistake number 1. Leaving your funds on an exchange. In November 2022, FTX, at the time one of the largest crypto exchanges in the world, collapsed in 72 hours. According to court filings and reporting by the Wall Street Journal, customer funds had allegedly been transferred to a sister trading firm. FTX founder Sam Bankman-Fried was subsequently charged with fraud and related offenses and was convicted in November 2023. $32 billion in value was erased. The individual investors who lost everything had one thing in common. Their assets were held in FTX's custody, not their own. The rule is simple: not your keys, not your coins. Mistake number 2. Trusting a single point of key custody. In December 2018, Quadriga CX founder Gerald Cotton died while traveling in India. With him, according to Canadian court proceedings, went the only known access credentials to wallets holding $190 million in user funds. No backup, no secondary access, no recovery. Investors had trusted one man with the keys to their money, and when that man was gone, the money was gone with him. $190 million locked forever behind a single password. Mistake number 3. Buying at the peak of euphoria. When Bitcoin reached $19,783 in December 2017, media coverage was at an all-time high and retail participation was surging. Within 30 days, Bitcoin fell 65%. Investors who bought at that peak waited over 3 years to break even. The mistake was not buying Bitcoin. The mistake was treating peak media attention as a buy signal rather than a warning. Mistake number 4. Confusing yield for safety. In May 2022, the Luna and Terra ecosystem lost $60 billion in value in under 1 week. The UST stablecoin had been marketed as a safe yield product, offering up to 20% annual returns. According to analysts and subsequent reporting, the stability mechanism was algorithmic, meaning it relied on market incentives rather than hard collateral reserves. When those incentives broke, the system collapsed within days. Investors who believed they were holding something safe were exposed to total loss. Mistake number 5. Ignoring counterparty risk. This is the institutional version of the FTX lesson. When you deposit funds with any platform, an exchange, a lending protocol, a yield aggregator, you are extending credit to that counterparty. You are trusting their balance sheet, their risk management, and their honesty. In 2022, Celsius Network, Voyager Digital, and BlockFi all filed for bankruptcy protection. Customers who had been earning yield discovered that their funds had been deployed into high-risk strategies without their full understanding of the exposure. $2 trillion in market value. Erased in a single calendar year. Mistake number 6. Ignoring wallet security. According to a 2023 Chainalysis report, $3.8 billion was lost to crypto scams and hacks in 2022. 35% of that figure was attributed to phishing attacks on private wallets. These were not sophisticated state-level intrusions. They were emails, fake websites, copied interfaces. Investors who had correctly moved funds off exchanges then lost them because they clicked a link that looked legitimate. Here is the reframe that changes everything you have just heard. Every mistake listed so far was not primarily a technical failure. It was a trust failure. People trusted exchanges, founders, yield numbers, and email links. The technology did exactly what it was designed to do. The human layer failed every single time. Mistake number 7. Failing to diversify across asset types. Investors who concentrated entirely in high-beta altcoins During the 2021 bull market, saw portfolios decline by 90% or more in 2022. Many of those tokens no longer exist. Concentration without conviction, holding assets you do not fully understand simply because they are rising, has historically produced the most severe individual losses in every documented market cycle. Mistake number 8, using leverage without a defined exit. During the May 2021 Bitcoin correction, over $800 million in leveraged long positions were liquidated in a single hour, according to data published by CoinGlass. Leverage does not change your analysis, it changes your timeline. A position that would eventually recover can be liquidated before the recovery arrives. Mistake number 9, mistaking a narrative for a fundamental. In 2021, entire ecosystems were built on the premise that transaction volume, social media engagement, and celebrity endorsement were proxies for value. According to data from DappRadar and subsequent analyst reporting, the majority of NFT collections that reached peak valuations in 2021 had lost more than 90% of their floor price by the end of 2022. A compelling story and a sound financial structure are not the same thing. Mistake number 10, having no exit plan before you enter. This is the mistake that compounds every other mistake on this list. No price target on the upside, no stop-loss threshold on the downside, no rule for what happens if the thesis changes. The investors who lost the most in every collapse described in this video were not necessarily wrong about the asset. They were wrong about their plan because they did not have one. 10 documented mistakes, 1 consistent outcome, preventable loss. These 10 mistakes are not hypothetical. They are documented in court filings, regulatory reports, bankruptcy proceedings, and on-chain data. This video is educational analysis of publicly available information, not a prediction of future outcomes for any asset, platform, or investor. No single pattern guarantees a result, but patterns that have produced documented losses deserve to be examined seriously before your capital is committed. The rage is not in the losses, the rage is in the precision. These were not random. They were patterned, they were traceable. And for most investors, they were entirely avoidable with information that was already public. So tell me in the comments, which of these 10 mistakes do you think is the most common one that people still refuse to take seriously? And if you have made one of them yourself, what did it cost you?